Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to talk about our monthly mortgage rate update for July. Where are rates today? Where were they? And what do we think is going to happen with fixed rate mortgages over the next 6 to 8 months? Stay tuned, you don't want to miss it. On this week's monthly mortgage rate update, we're going to unpack for the month of July where interest rates are, what some of the best rates being offered look like, and have a conversation about where we can see or think about where rates may be headed over the next 6 to 8 months. Obviously, last week we talked about CPI, inflation, headline inflation, coming down to 3.4% and how the Bank of Canada may anticipate this data. Obviously, we still await the July 12th rate announcement by the Bank of Canada. A lot of people, hoping that the Bank of Canada maybe doesn't increase policy rate. Many, according to our viewers in the comment section below, hoping that the Bank of Canada goes up. Obviously, with the higher cost to service mortgage interest, that is a very big factor of the CPI bucket, as you may recall. Taking a look at this chart here, we'll see how the cost to service mortgages has basically increased. It's actually almost the same as it was back in the late 70s, early 80s. Major difference when interest rates were around 18%. The impact to the cost of mortgages wasn't the same as it is today as back in that particular period of time. Maybe a lot of Canadians didn't have mortgages. There weren't lines of credits, that much credit card debt in the system. So the impact today is a much more significant to Canadians. And obviously, as we move forward, we do have Canada hitting a record 40 million Canadians. We do have a major problem, major headwinds when it comes to housing supply, housing needed versus housing that is actually being constructed. And this is obviously a big conversation point for many Canadians as they look to find answers to the questions about what they should be doing. We get calls every day regarding what clients should be doing with their renewals, what should they be buying, should they be waiting, and obviously the question is best answered by you, your partner, and your family on the needs versus wants on that home. Obviously, we tell clients every single day, you generally should marry the price, but date the rate, as rates are the volatile aspect. Obviously, the price of the home is fixed in the sense that if you were to purchase a home at a lower cost, as we saw over the past several months, we've talked to several clients when we were advising them back in 2022, the tail end of 2022, that home prices have come down to their low. Obviously, anything could have happened, but we saw a definite increase in home prices, a run up in home prices over the last 6 months. And many Canadians who may have purchased when rates were probably a little bit higher may have saved a significant amount of money on the price of the home, as we've seen the average home price in Canada rise. But obviously, that is a question that you and your family should be addressing. As I said, no one should be telling you when is the right time to buy. It is up to you and your family to determine when the best time for you to purchase is. But let's get into some of these rates right now, and obviously taking a look at where we are currently for the beginning of July, ahead of the Bank of Canada rate announcements. Just as a quick caveat, obviously for those Canadians who may be joining us for the first time, obviously welcome. Thank you for tuning in. When we talk about insured and insurable mortgages and conventional mortgages, there are some differences that many Canadians should be paying attention to. An insured mortgage is for purchases that are below $1 million, less than 20% down. And of course, you are paying the default insurance premium either to CMHC, the Canadian Mortgage and Housing Corporation, or to Sagan or Canada Guarantee. And there are some limitations, obviously, on that insured product. It can be a maximum amortization of 25 years with very strict guidelines when it comes to those servicing ratios. Then you have insurable products, which are on a hybrid. So basically, you can purchase with an insured mortgage. You can put more than 20% down. Depending on if you're putting 20 to 35% down, the rate may vary. Obviously, the more money you put down, the cheaper the rate. The least amount of money you put down, the more expensive the rate can get. And obviously, you have a purchase price of below $1 million, maximum 25-year amortizations, and ratios have to fall into the same guidelines. The major difference here is that with the insurable products, you can actually switch or transfer into these products. Let's say you had a mortgage that you started 5 years ago, it was a 30-year amortization. Now you're at 25 or less. well, you can look at these products, but they are not for refinances. They are for direct switch. You cannot add or touch that mortgage generate. There are certain limitations and there are certain exceptions. Talking to your mortgage professional about those options will help keep thousands of dollars in your pocket. And then there's obviously the conventional mortgages. Those are for purchases and refinances, equity takeouts. And if you want a 30-year amortization, you're buying over $1 million, most likely you're looking at a conventional mortgage at a 30-year amortization. You do have conventional products where you can take 25, but most clients in that particular situation are looking at the cost benefit in regards to their monthly payments. Taking a 30-year versus a 25 means better cash flow. Obviously, yes, more money goes towards interest because that rate might be a little bit higher, but most Canadians in this particular environment are paying very close attention to their monthly budgets. So let's get into some of those 5-year fixed mortgages. The 5-year fixed mortgages for the insured, best rate we're seeing right now is about 5.49%. Obviously, that has come up significantly, and we'll get into another chart in just a minute. And basically, you're looking at these particular products up to 95% loan to value. Then you have an insurable product. Those may range, as I discussed, about the down payment. You may be looking at anywhere from, let's say, 5.49% and upwards to 5.89 or 5.79%. And on the conventional end, we are definitely sitting at 5.79% plus with most lenders right now. 4-year is about 5.69% to 5.89%. And you're also looking at an insurable product in the yellow area here at 5.74% to 5.99%. And then obviously for a conventional mortgage, it's about usually 10 basis points to 15 basis points more. You're looking at around 5.84%. Moving on to the 3-year product, these are probably the most common right now. A lot of individuals are looking at the 3 or the 5. These are the most popular products. Of course, there's the 1 and 2-year. We'll talk about that in just a moment. But you're looking at a 5.89% insured mortgage for 3 years right now to 5.99%, depending on the lender and if there's any promotions. Then they have about, on the insured side, about 5.89 to 5.91%. And on the conventional side, right now we're getting around 5.91. We've seen a little bit lower, maybe about 5 basis points, depending on the size of the mortgage. Obviously, there are some expectations from clients to see if there's a negotiation that could be done. And obviously, as mortgage professionals, we do our best to try and achieve that rate for our clients. Then we move on to the 2-year product. You're looking at around 6.39%. And for the insurable side, which is for the switch and transfers, like we've talked about, it's around 6.39 to about 6.84%. And obviously on a 2-year, you're looking at around 6.34% and up, depending on the particular lender that you may be looking at. The 1-year, 6.79 to 6.94 for an insurable, and it starts at around 6.79 for a conventional mortgage. Now, obviously, keeping in mind some lenders have promotions, some lenders don't. Understanding what each lender is going to offer you when it comes to those particular conditions that are set forth by the lender. A lot of times we'll have clients that say, hey, we saw this rate online, and you go do a little bit of digging, and obviously you understand that A, that's probably an insurable rate, clients buying for over $1 million, A, the refinancing doesn't apply to them. So understanding what you're looking at when you're looking at those rates are very, very important, and not to get sort of stuck on that particular rate, because there is a lot of times where we'll have clients will see those rates and they'll say, hey, I saw that. And it's like, yeah, that's an insured product. I can definitely get that for you. But here are some limitations. Obviously, bona fide sales clause, not able to refinance or renegotiate, and you're sort of locked into that lender for that duration without the possibility of exiting, even if you had to pay a penalty to get out of that particular mortgage. So those are what we call our full frills versus the no frills lenders. And these particular rates that we've talked about are basically with insurable products that are with lenders that are going to allow you to actually do what you need to do in the event something happens and you're not hand tied to those lenders. Also, big component is portability. A lot of times clients may take a shorter term mortgage. They don't want to break that mortgage. All the products that we've talked about, the rates that are listed here below, give you full transferability or portability, we should say, into, let's say you bought a new house. And if you have questions about portability, about your mortgage, always feel free to reach out to us at InTouch Mortgage Solutions. We're more than happy to answer some of those questions. as well as talk to you about the options with particular lenders that we can discuss and that we know a little bit about. But let's get into where some of these differences are and obviously look at where rates have come from just over the last little while. And that is an interesting conversation because right now, what we've noticed from April to July is that we've seen a huge run up in rates. In April, a 5-year insured was around 4.49%. As of today, it's about 5.49%, like we've just discussed, and we've seen that sort of run up. Conventional's gone from about 5.09. May was like sort of that golden month for a lot of clients who wanted to lock in and get a pre-approval. If you did, and that pre-approval is still active and you're trying to execute on it, well, obviously, you're holding on to a very good rate and around 5.54% in June. In June, we did do a couple of updates because in June we saw some major upticks, and we will continue to follow the trends and see where rates are going. So make sure you're subscribed to the channel if you haven't already subscribed. Make sure you like, hit that notification bell, as well as leave a comment in the comments section below. It helps the YouTube algorithms and gets this content out to as many Canadians as possible. But obviously, we've seen those rates come up for 5-year conventional, as we discussed, to 5.79%. 3-year insured, 4.99 in April, and now we're seeing about 5.89%. So, it's gone up significantly in the conventional side, 5.04 to 5.91, maybe 5.89, depending on the particular product. But obviously, you're looking at rates that have gone up significantly over the last little while. And there's obviously some reaction in the bond market. Remember, 5-year government bonds are generally the barometer of how fixed rate mortgages are calculated. There is a difference between variable and fixed. Now, you may notice that we didn't cover variable rate mortgages. Right now, for a lot of Canadians, there's really no contemplation in the variable rate products. If you're looking to find out more information about what current variables are, you can obviously download our app in the description box below. You can play around with some of those mortgage calculators, but it does also give you a good indication of where variable rate mortgages are, depending on that type of product, if it's an insured, an insurable, or a conventional product. But understanding your exit strategies with a variable rate mortgage, understanding where interest rates are headed, obviously may impact your decision on whether or not you decide to choose a variable rate mortgage. Most clients that chose a variable rate mortgage over the course of the last few years were probably most likely to maybe pull out some equity to renovate, then sell, or obviously looking at short-term financing solutions when their mortgage had approached renewal. And a lot of the clients that we talked to are in that position. Obviously, some clients have chosen the variable rate mortgage because of the deeper discount, depending on when you selected that mortgage. And some clients chose those variable rate mortgages because there was a certain window of opportunity back in part of 2022 when fixed rate mortgages were starting to go up and variables were still very relatively low. And for qualification purposes, because remember, the MQR, the mortgage qualifying rate, is your contract rate plus that 2%. So right now, if you see the interest rates right now, well, they're hovering into the high 5s, mid to high 5s, high or low 6s, depending on the product that you're selecting. Well, obviously you're qualifying at 2 basis points above that contract rate. So you can see how the qualification can definitely make a difference in how much you can purchase for. So understanding those options. And if you noticed, when we talked about those 3 and the 5, a lot of clients who maybe wanted that 3-year rate because it's a little bit more short term, but because of their qualification when purchasing, while they may be leaning into the 5 because it may give them that buffer to get their mortgage approved. And I think that is something that is a good conversation for another video. We'll probably talk a little bit more about qualifications in the coming weeks and months ahead as we start to get a little bit more of a grounding on where interest rates are. But I think for the next 6 to 8 months, as the Bank of Canada continues to monitor the situation, especially ahead of July, we'll see if the Bank of Canada increases. If they do, we can almost guarantee that interest rates on the fixed end potentially could go up. We've seen them move up in anticipation, as economists are predicting that the Bank of Canada will make that move. So we're seeing those interest rates sort of reflective, and maybe we'll see a little bit more movement on July 12th or not. Depends on what you think or what the Bank of Canada will actually end up doing. And I know we've been getting a lot of feedback, but don't forget, you can always leave your comments and thoughts in the description box below. We do our best to read every single comment. And obviously, if there's any questions in there, we're going to start to introduce a question episode or parts of our video where we're going to be talking about some of your questions. So if you have a question, make sure you leave it in the description box below, and we'll address that question in future episodes. And we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking. Thanks for watching. We'll see you next week.